Now, even all the way down here, 40%, you're going to be trading a system that over time will make money. Statistically speaking, it will make money. Now remember though, this is saying that you're going to win 40% of the time is not the same thing as saying that the next trade you take has a 40% chance of success. It's not quite the same thing. Okay, the numbers just don't work out like that. Okay? However, you will have a good idea of what you can expect. Okay, that's why this is called the expectancy exercise. And again, I would invite you to play with some of these numbers. Okay, play with some of the risk. If you set this to, let's say, an automatic 35 pips, and you say, you know what, come hook or crook, I'm going to just place 35 pip risk, and I'm going to take off 3 lots in the beginning at 25 pips, and then I'm going to take off 8 pips when I get to 78. Okay, and then you look at the numbers, and it's going to tell you what you can expect. And you can look and see, well, wow, if I win 40% of the time, I'm still going to make some money. If I'm winning 60% of the time, I'm going to make some really good money. Now, to give you an example, most professional traders that I know operate down here at these levels, 20, 15, 30 cents at the most. So they expect if they put $1 in, they're going to make $1.15 or $1.20. Okay, it's a big shift when you start talking about what the professional players are looking for and what they expect to make once they're using their trading system. Okay, now let me scroll over here and we'll talk a little bit about this part of the spreadsheet. Now this is in the bottom left corner, and you can see I have this set for multiple systems. And actually this information here, it's just nonsense information. Let me take that off. Apologize for that. So now we have multiple systems. Okay, from here what I'm doing is totaling everything up. So this might be, let me give you an example. This might be where you found that you tend to trade in, let's say, 6 different ways. Okay, and if you've been trading for any length of time, you'll know that you may get an entry where you get a signal, but then you wait. You don't take it right away. You may find that you have 6 very common errors that you're making. Okay, so this could be 6 common errors. It could be 6 completely different kinds of trading systems. Either way, it doesn't matter. The important thing is to understand what the totals are. Okay, so let's say let's look at the worst case scenario where these are the 6 different errors that you're making, and they range in percentage wins. So you have 55, 45. One of them you're only winning 35%. Another one that's really bad is 33%, and then another 47, another 45. And these are your wins. Again, I said you're just making mistakes. So you've got your loss column over here, and your loss right there. Now, this actually was an exercise I was doing for the S&P 500, which is why you're seeing such small numbers. But we could make this really just about anything we wanted, where let's say we'll do 35 pips over here, where again, we're just going to say, I don't care what it is, every time I take a loss, it's going to be 35 pips. Now here's where you can really get an idea of what the long-term effects are of not letting your winners ride. Okay, let's just look at the numbers as they sit. Okay, if you're constantly pressured to take money off of the table, you get some profit, you just want to take it so you don't have a loser, here's what will happen. Okay, at 55%, if you win 15 pips, you lose 35, you're losing money. Okay, that shouldn't be a surprise there.